Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. It's Friday. It's March 24th. We're entering the last week of the month. This quarter is almost behind us. It's about 7:54 in the morning. I'm doing the video a little earlier. And boy, oh boy, I'm going to tell you, those algo traders are doing everything humanly possible to shake us out. I want to show you guys something really interesting. This is a chart. This is a chart of a 1 to 3 year treasury bond. This equals roughly the 2-year bond. About a year ago, roughly about a year, maybe even more, Paul Tudor Jones came out and said that this market is going to turn around when the market stops reacting. The 2-year note stops reacting to the Fed rate hikes. Well, I want to show you the last couple of days of data. Look at what the 2 years doing. It's going up. It's not going down. And by the way, I warned you last week that we're very near the floor, that the 0.25 is already priced into the market. That's one of the reasons why I went long utilities, because I thought utilities were going to follow bonds, which is what they usually do, but the market offset that. But the point I'm making is this is the first rate hike where the 2-year bond is actually moving higher, not lower. And I don't think it's algos taking them. I'll get into the algos in a minute. But this is a very, very positive sign. And this is a sign that's telling us that the market does not believe that the Fed is going to keep increasing rates. Look at that. 10-year too. 10 years moving up. 2 days. Look at this. I'll show you. 2 up days. And then look at where we're at right now. We're up 0.80 higher. So the 10-year and the 2-year, 1 to 3 year, I call it the 2-year, but this is the cash equivalent of a 2-year bond, is telling us that markets don't believe that the Fed is going to raise rates. And that kind of goes hand in hand with the fact that we've been seeing technology, and let me show you the technology stocks, leading the last couple of weeks, not lagging. Technology, consumer staples. Now, my theory was, and everybody has a theory, my theory was that they're overbought and they're going to be coming down at the expense of others. But now that I'm seeing the bond market react this way, the bond market is telling us that the Fed is done raising rates. I know it may happen, it may not happen, but that's what the bond market's telling us. And if you go back, I should find that video somewhere. But Paul Tudor Jones, this is a self-made billionaire hedge fund manager, and he said when the 2-year and the short-term bond stops reacting to the Fed, that's when it's done. And lo and behold, it happened. Same thing happened, by the way, when they were raising rates. They started raising, and then the bond market just stopped reacting to it, and that's when they stopped. So the bond market does not believe that the Fed is going to be raising rates, and that's a very, very positive tune for the market. Also, remember, small caps, as I showed you, have not been impacted very much. Look at that. They've been just moving sideways. I mean, really, really moving sideways. Look at that. Just kind of in a channel all the way since last May. By the way, I pointed this to you guys last May that we bottomed out. So there's a really good chance the market may be bottoming out. Now, in light of that, let me show you what the algos are doing right now. Look at how they're pulling back real estate. Look at how they're pulling back industrial stocks. Look at how they're pulling back on the financials. They're trying to trigger sell stops at the lower levels. But if you look at momentum levels, which we will do right now, you will see that these assets practically have no place to go. For example, look at financials. Look at how oversold they are. Look at where they're at. So what I'm seeing is I'm seeing a bunch of funds trying to trigger sell orders and trying to bring fear into the market due to financials right now. But financials are way, way overdone. I mean, look at that. They are overdone. Really, really overdone. They just don't have much more to go. A little here, a little there. So as far as I'm concerned, what I'm seeing right now is a bunch of nonsense and a bunch of funds trying to trick the market into thinking we're going lower. But in essence, I just don't see much more downside. I honestly don't, because we are so oversold in the short term. And also because of technology moving higher and volatility not moving against us. And the 2-year, the bond market, 2-year and the 10-year, they're moving higher. So I am very skeptical right now about this downside trading action, and I genuinely believe that the algos are trying to push us lower and then take the market higher. By the way, another factor, I checked the seasonality over the last 20, 30 years, and this period, the 24th through the 30th, something like that, there's a 5-day window where the market is actually pretty strong. So I'm a little skeptical about what I'm seeing, and I think we may have a nice little juicy reversal over the next couple of days. But what I'm seeing right now from the algos is trying to pull down the stops right here on utilities, on industrial, on real estate, right here, on consumer staples, and on financials, mostly financials. They're really taking it under the chin. But when I see these little lows, I get really skeptical when I see momentum levels at the bottom. So we got to be really, really careful right now. But I'm telling you, as I sit here, this is one hell of an oversold market. I mean, look at the divergence here. Up, down. That usually does not sustain itself. So I am actually looking for the market to rebound and move higher over the next few days as a whole. Not sector specific, but the broad market. Now, there may be some sectors that are not cooperating with us, but I do believe the market is going to head higher and not lower. Now, let's get into today's agenda and today's news. But I wanted to tell you that because it is Friday, and on Fridays, we always talk about algos. So I'm actually becoming more and more bullish on the market than ever because of the 2-year note, the reaction to the Fed, because of the momentum levels, and because technology is leading and small caps are not falling. So it's not just one reason, it's not just 2 reasons, it's not just 3 reasons, it's 4 reasons plus seasonalities on our side. So I'm a little skeptical about this downside move. We may see some choppiness, but I think the downside is overdone. And you know me, I'm not a big pick tops and bottoms guy. But I think because of the 2-year and the 10-year, the way they're reacting and the way tech is moving, that this market really needs to start coming up and not down. So U.S. benchmark indices closed higher yesterday after Janet Yellen's remarks on banks. In Thursday's session, regional bank stocks resumed their sell-off, with FRC tumbling 6%, not 30%, just 6%, after Secretary Janet Yellen told lawmakers she was prepared to take additional actions if necessary to protect deposits. I don't think what she said was that inflammatory. Oh, I got my cat right there. I just realized that. In Thursday's session, regional bank stocks resumed their sell-offs and 6%. So it's a little better. At the same time, technology stocks outperformed as Treasury yield, bonds going higher, Treasury yields plunged on bets that the Fed may be nearing the end of their rate increase cycle. When you hear the Fed raising rates and you see the bond market going higher, remember, there's an inverse relationship. So interest rates went lower on the Fed saying they're going higher. I'm not kidding. Look, it's right here. It's right there. This is when he said the statement. They were right here. They're right here now. You can't make this stuff up if you tried. Meanwhile, borrowing the Federal Reserve discount window stood at $110 billion as of Wednesday. Lending from Fed's Bank Term Funding Program rose to $53 billion, with loans to foreign central banks climbing to $60 billion. Now, yesterday we had the labor market report, unemployment benefits, and they were fine. I mean, they were dropping 1,000. I mean, we've been around 200,000 now for 2 years. It's been really steady. What I like to hear was the fact that new home prices increased seasonally adjusted annual growth rate. Now, they're still about 20% below last year, but they're not doing as bad as we thought, and they're better than expectations. Today, we're going to be looking at durable good orders. They're coming out. Let's take a look when they're coming out. Let's take a good look to see when they're coming out here. They are coming out at 8:30. They're coming out in about 28 minutes. And Bullard, James Bullard speaking, he's not as bearish typically or sheepish as our friend Squirrely, as I like to call him now. That's my new name for Powell, Squirrely. So we'll see the durable good orders. They stood at negative 4.5% in January. We'll see if they're positive. If they're positive and if Bullard says some nice things, which I hope he does, I don't think things are going to be as bad as they seemed this morning. European futures are down 1.62% this morning as investors digested a slew of important regional economic data. The latest data from the banking sector. Deutsche Bank plunged 8% over the cost of default insurance jumped. But again, it's just heightened sensitivity right now. China closed lower as elevated U.S.-China tension. We're back with the tension. Weighted on investor sentiment. Lawmakers on Thursday battered TikToks about China's influence over the platform and accused TikTok of serving harmful content. Ay vey. Biden administration recently demanded TikTok owners divest their stake or face a ban. Blah, 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 blah. I mean, really, TikTok? TikTok is going to raise tension with China? This is what I call overreaching. This is looking for something when there's nothing there. It's one company. Take it easy, okay? Take it easy with TikTok. Japan closed lower. They were doing pretty well for a couple of weeks, but they were weighted down by financial stock turmoil around the globe. They're the third biggest economy, and they're very much dependent. Also, their CPI number, which is a core CPI, slowed for the first time in 13 months. That's what you guys get for keeping rates low and keeping your head in the sand. We had some downgrades on Block, which is a financial it's a financial tech stock. Is it a financial stock? Is it a tech stock? It's very mixed. But they were downgraded by Atlantic Equities, which is not a big firm, but the stock is down 5%. There's no major earnings today, and according to seasonality, most sectors are supposed to actually rally over the last 20, 30 years during this time period. So I'm a little skeptical about this downside pressure we're seeing on the market. Now, in terms of sectors, let me just give you the whole enchilada here. Technology and communication services continue to rally. I really like industrial and consumer staples. I like basic materials. I don't like consumer discretionary, especially after Nike's came out with a really nasty report. I like healthcare. I like utilities. I think utilities are going to be coming up. Matter of fact, let me show you the sectors that I am putting a lot of weight in the next couple of months. Utilities, real estate, financial, energy. I think those will be moving higher. I'm very much encouraged by consumer staples because they're actually not moving down. They're actually moving up in the short term. I like that bounce. And they've been holding on pretty steady. Be really, really cautious right now because technically wise, we're seeing a lot of these stocks, as I mentioned earlier in this video, a lot of ETFs making lows. I don't think these lows are going to hold, and I think we're going to get a shakeout specifically because the bond market is giving us relief. It's giving us relief right now. It's not moving lower, it's moving higher, which means interest rates are getting lower, which means it's going to be easier for financial companies and other companies to navigate right now. Remember, banks make their money on spreads. Lower rates can, and I mean, these are not lower rates by what the bank is charging. These are very small fluctuations in the 2-year, but that's a very, very positive sign. That's a very, very positive sign in terms of the overall economy. In terms of stocks that are leading, let me show you. There's some doozies out there right now. A lot of technology. But let me show you. ADI, C Limited. It's an e-commerce site. This was one of my darlings during the bull market. It's coming back. Agilon Healthcare, Allegro Microsystems, Squarespace. A lot of the stocks that I talked about earlier this week. Spotify's been doing great. Lattice Semiconductor. I've been wanting to get into the stock like a rascal, but the spreads are too wide. And a few others. GE is also doing really well, by the way. The point is, markets are starting to change their dynamics. Small caps, tech leading. I'm starting to smell that there's going to be a rally on the way. I think all of this downside with the banks need to be forgotten, and I think the algos are trying to push the market lower before taking us higher right now. I'm about 80% certain of that. Not 100, but about 80%. Now, folks, before I let you go for the weekend, don't panic. Lower your exposure, be diversified, stay away from most financial stocks, even the insurance stocks, unless you want to short them. And I'll be giving you some seasonality today in the VIP room and in the midweek roundtable, not midweek roundtable, and Ask the Pros. I always confuse those two. Today's Friday. So my VIP room's at 11 and Ask the Pros is at noon, and I'll be there and I'll show you some goodies there today. Don't miss out on there. And also, before I let you go, folks, my good friend, really good friend, we had dinner last night. We had a blast. Chuck Hughes, he's about to expose one of Wall Street's best kept secrets. It's a new way to potentially get ahead of the game. And what I love about this, it takes all the nonsense people hate. You don't have to hold positions for a long time. You don't have to buy expensive options. You don't have to be in positions forever. And it's very, very, very fun. It's a fun system to trade. The way Wall Street invests is changing, especially with all these algos, moving all of its biggest transactions to a certain hour of the day. And while they've kept the secret buried for months, even years now, we're going live at 1:30 p.m. Eastern to pull back the curtain and reveal how the rest of us can target these power hour stocks. Follow the link below. Check it out. It's going to be live. No monkey business. And if you behave yourselves, maybe we'll even give you a trade for that you may want to put on at the end of the day. It's going to be hot meat today, guys. Hot red meat is coming your way. Don't miss out. 1:30, not 1:30, the 24th of May. Is it May already? March, 24th of March. You got to watch me carefully. 24th of March, 1:30 p.m., Friday. Don't miss out. It's going to be live, not Memorex. and we'll give you a hot red meat trade if you attend. Bye, guys. Have a great, great weekend. Send me emails, like our channel, subscribe to our Telegram channel. The link is in the YouTube Wealth Press channel, and post comments, and I'll respond. Bye, guys. Have a great, great weekend. I'll see you soon. Any questions, comments, feedback, support@marketgeeks.com. Bye.